If I had to choose three words to describe the industry, I think they'd be, innovative, dynamic, and invigorating. So the industry has grown nearly 25-fold in the last 20 years. When I started, the market was only about $7 billion. Last year, it was nearly $165 billion. 80% of the top 100 GPs in the world have done a continuation solution. Multi-asset CVs tend to be a more diversified, lower risk proposition, but single asset CVs can offer higher alpha. On average, there's about 10 to 15% of rollers into continuation transactions. So everybody's focused on the GP rollover, everybody's focused on the GP, the carry structure. But who's getting that carry? Right. We don't believe that evergreens should be targeting lower returns than commingled secondary funds. And we're starting to see CVs on CVs, and this industry being full of jargons, what I've heard them referred to as CV squared.
Hello, everyone, and thanks for tuning in to another episode of Women of Secondaries, produced by Secondary Link and hosted by yours truly. I think by now you know I'm Kristina Kulikova, Senior VP of LP Advisory at Deutsche Capital, and I love hosting this show. I feel so privileged. We really cast light on absolutely powerhouse women driving this industry, and I love hearing their expert views on the various secondaries topics on hand. And of course, if you missed any of our prior episodes, we have them posted on the LinkedIn page, on the Secondary Link video and podcast section, on YouTube and Spotify. So lots of places for you to listen. And what's exciting is, I was just at Super Return Miami last week, and there were so many secondary panels. There's so much buzz about secondaries that it's just, you're in the right place at the right time. And today marks our 11th episode for Women of Secondaries, and I'm so grateful for your support, for your feedback that you've given us on the show, for who you want to see, what topics you want covered. So I really feel blessed to actually be able to have this episode where we have an absolute industry veteran sitting down with us today for an in-depth discussion on the GP-led secondary market, which has, of course, exponentially grown and has become pretty much half of the secondary market volume today. And this industry titan has been in secondaries for I think over 20 years, and was one of the early adopters and pioneers of the GP-led secondary market, particularly in Europe. And she currently serves on the advisory board of funds managed by Astorg, CapVest, Deutsche Telekom Capital Partners, Mandarin Capital, PAI Partners, Pollen, the list goes on. And of course, I'm speaking about none other than the London-based Managing Director, Valérie Handal of HarbourVest Partners. Welcome, Valérie.
Thank you, Kristina. It's a pleasure to be here, and thank you for the opportunity.
So excited to talk to you today. And HarbourVest is obviously one of the main players in private markets today, with more than, I believe, 143 billion in AUM globally, right across primary funds, secondary funds, direct co-invests, all asset classes, private equity, real assets, infra credit. And you've had an extraordinarily successful career with the firm, as I understand, since 2006, if I'm correct on that. And before that, you were in investment banking, venture capital at Merrill Lynch, Bank of America, SoftBank Europe Ventures. Can you give us a briefer on what caused the transition to HarbourVest?
Yeah, sure. So look, as you mentioned, I started working in secondaries nearly 20 years ago. And secondaries wasn't particularly an obvious career choice for me. Frankly, I think that anyone who's been in secondaries since the early days of the industry really stumbled into it a little bit as I did. Look, as you mentioned, I was in investment banking. I had venture capital experience. And overall, I was interested really to move into private equity investing. I knew this would be something that would interest me, would stimulate me. So I started speaking to friends in the industry, and one of them suggested that I meet with a firm called HarbourVest. Candidly, I didn't know much, if anything, about HarbourVest, and my friend didn't either, by the way. But he thought, I guess he had heard through the grapevine that they were recruiting. So I figured, I have little to lose. I want to do private equity. This firm does private equity. So I'll meet with them to learn about their business. You also have to understand, that at the time, it's not like today where, candidates come to us and they're super prepared. They've done their research. At the time, the internet wasn't so prevalent and what you found on the internet wasn't very useful. So I went into this quite cold, actually, not knowing a lot of information about the business. But I met with HarbourVest. The meeting went well, and in the conversation, they mentioned that they were building a dedicated secondary team in Europe, and asked me whether I'd be interested to be considered for the position. And as I said, to be honest, I had no idea what they were talking about when they mentioned secondaries. So thinking, okay, how do I sound vaguely intelligent in answering this question? I figured, well, I would turn the tables around and ask them why they think I should consider pegging my career to an industry that was so niche that most people, including myself, had never heard of it. And it just happened that the founder of our secondary business was in London visiting. So I was fortunate to be able to meet with him right there and then. And I have to say, he was very convincing. When I asked him the question directly, I think he said something. If I were in your shoes, the way I would think about this opportunity is, do I want to be a small fish in a big sea? And the big sea referring to the buyout industry, which back in the day already felt quite well established, certainly when compared to secondaries. Or do I want to build something meaningful and be a big fish in a small sea that has the potential to become a very big sea? And this gave me a lot of food for thought. And, after multiple conversations with HarbourVest, I have to say that HarbourVest was and continues to be very thorough in our recruiting process. I accepted the offer to join the firm. So, and here I am nearly 2 decades later, having spent all this time in secondaries.
That's incredible. I usually, whenever I've had my past interviews, I would say, how did you end up in secondaries? But I think in this instance, the appropriate question is, how did you help catalyze secondaries? Because it really was its incumbency at the time when you joined.
No, indeed. Early days, very early days.
Yeah. And so how would you, looking back and sort of looking at secondaries where they are today, how would you describe the secondary market in just 3 words?
So, look, if I had to choose 3 words to describe the industry, I think they'd be, innovative, dynamic, and invigorating. Innovative because this is an industry that evolves continuously and never stops innovating. If you look at GP-leds, they started with team spinouts from large corporates in the early 2000s when I started my career. And then we saw team buy-ins. We've seen NAV facilities come into the market, all the way to the multi-asset GP-leds of today. And also more recently, you've seen the emergence of single asset deals. On the LP-led side, there's been new structures such as managed funds or joint venture deals. You see structured liquidity solutions. So really constant innovation in the secondary market. And frankly, I'm curious to see what the future holds for the market. In terms of dynamic, I'm referring to the growth of the industry. So the industry has grown nearly 25-fold in the last 20 years. When I started, the market was only about $7 billion. And last year, it was nearly $165 billion if you look at Evercore's data on the market. And what's exciting is that each of its subcomponents have been truly dynamic, so each growing substantially in the last couple of years. In addition to that, you have secondary markets emerging in new asset classes like infrastructure, credit, real estate secondaries, and also new ways of providing access to the asset class, like the evergreen funds. You'll tell me these are not unique to secondaries, but I would argue that secondaries are particularly well suited for these types of vehicles. And then lastly, I said stimulating. Really, it's as a result of all this growth, all this innovation, there's never been a dull moment in the industry. And all this time that I've been in the sector, I've never been bored. There's always something new to discover, or dare I say something new to pioneer. The market has had great tailwinds. And really, at the end of the day, this makes for a very fulfilling career. But what's extraordinary and what I think is truly exciting, and this is something I tell new recruits on our team, is that I sincerely believe there's still so much to do in this market. And I think that the next 20 years should be as exhilarating as the last 20.
Absolutely. I think you nailed it, because everybody that, we work on the advisory side, of course, and Sutter actually started in 2006 as well. So it's sort of seen that evolution, right? Yeah, of secondaries, but it's come such a long way. I mean, looking at even the reaction of limited partners to potential secondary transactions and GPs alike. I mean, I think we've gone such a long way. And every time I'm speaking to a group, they say, wow, it doesn't stop to surprise me how many innovative ideas there's constantly coming up, whether it's, as you said, spin outs or NAV lending or fund finance for secondaries or sublines, whatever it is, right? And different structures, pref equity, what have you. So it's definitely fun. You can't deny that.
Indeed.
And you briefly mentioned this, where you said, there's obviously a little bit of a bifurcation of some sorts between the single asset GP-led market and the multi-asset market. When we look at continuation vehicles, can you speak to some of the attractiveness of one strategy versus another, and maybe what are the main differentiating points on that?
Sure. The way I would think about it is not that, one of these types of deals is more attractive than the other. Rather, I think they're different deal types, even though they're, continuation vehicles, but one's multi-asset, the other one's single asset. And their relative appeal really depends on what investors are aiming for. So, on the one hand, if you think about the multi-asset continuation vehicles, they offer a more diversification by definition than single asset deals at the deal level, and therefore they're less risky. They also tend to encompass assets that are at multiple points in their value creation journey, and as a result have different value appreciation potential. So given that, they offer the potential for some assets to generate earlier liquidity, but at the same time, in aggregate, they probably don't have the same absolute return potential than single asset continuation vehicles. On the other hand, when you look at single asset continuation vehicles, they tend to represent highly performing assets of a GP that often are sort of overachieving the GP's initial investment thesis and overachieving their returns expectations. And here the GP's looking for a way to keep hold of that asset for longer and also raise more capital for growth initiatives as an alternative to an exit to another sponsor, for example, or to a strategic, given the value potential that they see in the asset. And so at that new entry point, single asset CVs tend to offer private equity or buyout type returns to the new investors. That being said, and I talked about risk, whilst they are sort of, they're less diversified than multi-asset CVs, we believe that they also offer lower risk when you compare them with new buyouts, given that the GP and by extension, the new investors alongside the GP are not taking what I would call new deal risk, given that the GP has already been invested in the asset for a number of years, and you can evaluate the performance of that asset under the GP's ownership. So in summary, multi-asset CVs tend to be a more diversified, lower risk proposition, but single asset CVs can offer higher alpha. As an aside, I would note that you can achieve that diversification with single assets by constructing a curated portfolio of single asset transactions. Overall, and a little bit in summary, I think that both types of deals have their place in a private equity portfolio and are highly complementary. And that's why I think we're seeing LPs, depending on their objectives, allocating to either one or both types of strategies alongside either their buyout portfolios or alongside a more diversified secondary exposure.
Yeah, it's an interesting point where you mentioned about the multi-asset CV deals. Of course, we're going to talk about, alignment and some of the reasons for why these transactions happen. Do you ever see where a GP takes a trophy asset and, let's say, utilizes it to bump up the other assets in the multi-asset continuation vehicle, right? So they'll say, okay, we're going to use this trophy asset, but the others, they're not best for single asset CVs. They're, maybe won't garnish the same response in the market, but we could use this trophy asset to catalyze that joint sort of CV. They're probably analyzed individually, but do you see that happening a lot?
A lot, maybe not, but it has happened. It's a little bit what you're seeing in multi-asset CVs, that there are some very strongly performing assets, and then maybe towards the tail end, these assets are sort of average performers, or some have had bumps along the way. But in general, what you're also seeing in the secondary market is that now buyers are being extremely discerning. And so generally you will have the ability to cherry pick assets. So in a situation where you have a trophy asset and then a number of other assets, that's not to say that you end up with very difficult assets in your portfolio. Sometimes, we would exclude those. And, it's a conversation that you have with the GP to construct a group of assets that you think make sense, that you think have potential. And then obviously doing deep due diligence, bottoms up valuation to understand what you will pay for that collection of assets, that portfolio of assets.
So if I'm hearing you correctly, there is some guidance that the market also provides to the GP based on their feedback on the assets of what would make the most successful sort of multi-asset approach to a CV.
Absolutely.
That's great. And in speaking about valuation and sort of getting to a deal that works, how do you approach pricing in GP-led secondaries? Particularly, we can start more holistically, but also with the impact of a lot of volatility in the market now, whether it's geopolitical, whether it's tariff threats, whether it's interest rate changes. Maybe talk through that a little bit, how you guys are approaching.
Sure. I think, look, the more concentrated the portfolio, the more the diligence approaches that of a buyout transaction. So really what we do is that we perform deep bottoms-up analyses for companies in the CVs that we analyze. And we look at everything that you would think of, the operating model of the business, there's the company's strategic positioning, the industry dynamics, the industry attractiveness, the quality of the management team, et cetera. And then we build detailed financial models to capture our expectations for the business. We also obviously look at the balance sheet of the business, its cash flow profile in our analysis. But also importantly, to all of this, we overlay the capabilities of the GP. Because at the end of the day, you're not only buying a business, but you're buying a business alongside a GP and are trusting the GP to manage the asset on your behalf going forward. So we look at the track record of the GP, we look at their experience navigating difficult environments, especially in the current market environment. We look at the performance of the companies under their ownership, et cetera. And then looking at the valuation side of the equation, our approach is equally granular. We perform a very thorough review of, everything from precedent transactions, listed comparables, and we also look at the evolution of valuations over time, again, to make sure that, a certain point in time is not biasing our view of valuations. We have a database of over 40 years of private markets data where we track over 5,000 managers. We have over 70,000 companies in our database. And this really gives us strong insights into private markets over multiple cycles and multiple points in time, and we can use that to factor it into our analysis. So you mentioned the current turbulent environment. Normally we perform scenario analyses, and obviously now more than ever, we look very closely at these various scenarios, really to understand the range of potential outcomes for the businesses under multiple scenarios. I guess, look, on the topic of valuation, I think it's important to highlight that the price that we're willing to pay, and this may be counterintuitive to people outside the industry who think of secondaries pricing as discounts or premiums to NAV. At the end of the day, the price that we're willing to pay is really an output of our modeling and our deep dive into the asset, and reflects, that sort of conviction about the asset. And it's only when we have the price that we then compare it to the NAV to gauge a little bit where we are versus where the asset is marked. And this will be the benchmark that, LPs, when they're evaluating a CV, or even the GP itself, will benchmark our price against. But it's really not where we start, I guess. And maybe lastly, and it may be self-evident, but I'll stress that, discipline around pricing is incredibly important for us. And look, we're fortunate enough to be able to source a really wide range of opportunities. So frankly, we're happy to walk away from a transaction if we think that, a transaction's overvalued and concentrate on other parts of our pipeline. And to come back to your previous question, if we think that a portfolio composition doesn't make sense, unless we can work with a GP to curate the portfolio, we're happy to walk away and, spend time elsewhere.
Yeah, and I think with the growing popularity of CVs, there's definitely no shortage of supply of opportunities. You mentioned an interesting point about obviously LPs that are on the other side of this transaction, right? And inherently, there is some perception of either conflict of interest or sort of stigma about GP-led deals. And I think it almost goes twofold. One, from sort of a resource standpoint internally for the LP to actually evaluate these opportunities when they come up, like such as, on your end, you have a very vast team. There's resources dedicated to modeling, et cetera. Sometimes for LPs who may have, 5 CVs coming to them at the same period of time, it's difficult to probably evaluate all of them and make a decision in a 30-day window, let's say. And then, of course, there's conflicts about how much does the GP roll forward of their carry, et cetera. Would you say that institutional investor appetite for CVs or comfort around CVs is growing, or are there still sort of reservations that have to be considered and adhered to when a GP is leading their process? And in line with that, maybe are there things that the GP can do in communicating to their LPs or preparing for a process that would increase LP comfort with the various deals?
Yeah. So look, certainly we are seeing LPs becoming more comfortable with these processes. In the secondary market, it always takes time for the market to fully understand and accept new deal types. So, I'll remind people that, there was once a time when LP deals were controversial, right? Today, nobody bats an eyelid if there's an LP deal in the market. But it's true, as you highlighted, that these types of deals are the GP-led side types of deals are different because of the conflicts of interest, and also because they do require LPs to take decisions, right? That they were not, these are not transactions that they initiate themselves, and they find themselves confronted with having to take a decision on rolling, on selling. And again, as you highlighted, they may not be staffed, they may not be equipped to fully take advantage of, those decisions. And so, I think it is paramount for GPs to have conversations early with their LPs. It's important that they make themselves available to walk the LPs through the transaction, that they explain the rationale for the transaction, that the information that is provided to the potential acquirers is made available to the LPs. And what we are seeing is, especially in a sort of distribution constrained environment, LPs have, become more accustomed to these types of deals. They are more open-minded, more accepting. And what they are starting to do is to work with people like us to help them evaluate their sell roll decisions, or take, or sort of invest in the asset class, but through in a more organized way. So in a fund dedicated to this part of the market.
Do you ever have LPs, let's say major LPs in the fund, speak to you during the process of continuation vehicle deal and kind of vet your thinking about what you see in the deal based on, for them to base their decision about whether to roll or to sell?
Absolutely. And, this is a service that we provide to our LPs. They will call us and ask us about our views, obviously with the GP's consent and the GP's, blessing. We will speak to LPs about how we see a transaction, especially if we're leading the deal. We can give them very full insights. But generally, we see most, if not all, transactions that have come to the market. So even if we're not in the deal, we're able to give them a view as to why we're not in the deal, what were the areas of concern, which they can then take away and reflect on.
Excellent. And I think also as more time goes on and as this becomes popular, we'll probably start to see it reflected in LPAs as well when groups initially commit to the fund, right, where there is a possibility of CV or how it's governed or whatnot. Because I think that was probably the biggest barrier as well, is that there weren't clearly defined terms in the LPAs or for LPs when this started happening, right?
Yeah, no, absolutely. Absolutely. It is a trend that we're seeing where the rules of the road, if you want, are pre-inked into LPAs so that, the GPs know what they're getting themselves into.
Are there, from an LP perspective, are there rules of the road, as you said, to assess whether GPs' incentives in a continuation fund are truly aligned with the LPs in the transaction?
I mentioned the importance of price to us in a transaction. For us, GP alignment is equally as important. And I think, a lot of people mention GP rollover and how much was the GP rollover of carry, etc. It's obviously a big component of the GP alignment, but the way to think about it is really a package that goes beyond the GP rollover of carry. And for us, we look at obviously how much the GP is investing, how much percentage rollover is happening, but also we look at the absolute quantum of money that's being invested alongside us and whether that's meaningful in the context of, the GP's franchise, etc. We also pay very close attention to multiple other variables that may not be so obvious, right? The level of management fees, the level of the carry tiers, and whether, those are creating alignment with us. And then you have things like key persons, right? Who are the key persons in the transaction? And are they the right ones? Everybody's focused on the GP rollover. Everybody's focused on the GP, the carry structure. But who's getting that carry, right? And so the distribution of the carried interest among the team is also important. How quickly does it vest? Because, you could have a situation where it vests so quickly that, after a few years, everybody's gone and, they took all the carry with them, quote unquote. So all this forms part of the equation in terms of looking at GP alignment. And frankly, because it's so important to us, that's why we're trying to position ourselves as leads in most, if not all, of the deals that we do, so that we can be at the negotiating table and really structure that package to make sure that there's maximum alignment.
Given this rise of GP-led secondaries, which is not a trend, it's really here to stay as an avenue, as an exit avenue, is it affecting the balance of sort of power between GPs and LPs in the transactions generally?
Yeah, no, look, it's a good question. As you said, GP-leds are certainly becoming a more common tool for GPs to offer LPs liquidity. But at the end of the day, we believe that these transactions really need to be done right for GP and the LP relationship to remain healthy. Let's not forget that the GP is certainly doing the GP is doing a CV, that's fine. But let's not forget that the GP will also be speaking to the same LPs about committing to future blind pool funds, and that these fundraisings really depend on the GP's strong relationships with their LPs. So maintaining the right balance is very much in the interest of the GP as well. And from the perspective of a buyer, such as ourselves, we want to see this balance. We want to see that, the GP's franchise is stable. And, the ways LPs are treated is also a factor that comes into consideration when we evaluate transactions. We mentioned this briefly, or you mentioned this actually briefly earlier in our conversation, but we're also seeing sort of successful negotiations from LPs, such as the ILPA standards around GP-leds, or what I called earlier the rules of the road, where provisions for CVs are being incorporated into flagship fund LPAs. But regardless, in all instances, setting out expectations in advance and communication with LPs, with clear communication, advanced communication, is essential, we think, for successful and healthy LP-GP relationships.
Yeah, because the LPs obviously remain the bloodline, right?
Absolutely.
The lifeline of the franchise.
Absolutely.
I don't want to say we see this often, but we do see it happen sometimes in LP tenders, for example, right, where a GP will encourage their LPs to sell just to be able to establish a stronger relationship with the incoming sort of anchor buyer for their fund, either from a reputational standpoint or from a capital standpoint, or et cetera. Do you see this happening in GP-leds where, the GP wants to align themselves with the lead of the GP-led and sort of has ways or strings that they can pull on to encourage LP selling versus rolling?
Yeah, no, it's a good question. I mean, look, I think there are certainly conversations that the GP has with their LPs. And I would imagine that, if an LP is not continuing with the relationship, you can assume that they would be more inclined to sell. But all that being said, if you think about it, I think the statistic that I've seen is that around, on average, there's about 10 to 15% of rollers into continuation transactions. So potentially those conversations don't need to happen because there are plenty of sellers to date in these transactions.
Oh, that's helpful context, actually. And coming back to an earlier point that you mentioned with the rise of the 40 Act funds, especially I would say, there's tens of billions of AUM, probably approaching 100 billion in the 40 Act funds over the last 4 to 5 years. Is it putting pressure on the competitive dynamics in the market for buyers such as yourself, whether that's pricing pressure for deals or fee pressure or capitalization? Maybe speak to that a little bit, and actually specifically how a group that does have an evergreen vehicle and a commingled vehicle, how do you balance where the deal goes, et cetera?
Yeah, no, look, it's an excellent question and one that we are getting more and more. But our understanding is that, in the current evergreen market, even though it's had a very strong growth recently, but currently we understand that the majority of players are allocating the same deals between their flagship commingled funds and their evergreen products, which is certainly what we're doing. So as long as this continues, we don't really expect to see such pricing pressure that any one part of the market becomes off limit to us. It's true that on the margin, you may find secondary GPs who source deals solely for an evergreen vehicle and price those assets at a lower expected return because they assume that retail investors have a lower cost of capital. And, with that sort of in mind, it allows them to come into some transactions and outprice those who are underwriting to more traditional private equity returns. And we've seen this particularly in, for example, tail end assets, where higher discounts and the faster return of capital could be attractive for these types of buyers. But frankly, that's a part of the market where we don't play in, because in those types of deals, after the initial pop in valuation that you get from the discount, the future value appreciation potential of the assets tend to be very muted. And so that's not, a part of the market that we play in. All that being said, one has to wonder how sustainable that strategy will be if, other evergreen vehicles have the same underwriting standards as sort of commingled funds and therefore, should have a better track record and offer higher return. And so, will that sort of create the discipline in the market so that, you're not seeing too many of those types of instances? So, in summary, I guess what I would say is that we don't believe that evergreens should be targeting lower returns than commingled secondary funds. And whilst it's true that we're in the sort of first innings, if you want, of this evergreen market journey, and its ultimate impacts on the secondary market are probably still playing out, we think overall it's a very exciting opportunity that evergreens offers the secondary market. And as I mentioned before, we also think that the asset class is very well suited for evergreen structures.
Do you subscribe to the sort of belief, or I should say the theory, that evergreen are less focused on DPI? They're a little bit more focused on the ability to provide liquidity, if and when needed. And so because of their reinvestment of proceeds, they can actually have a lower cost of capital a little bit versus a commingled fund.
Yeah, so it's interesting. And I think there are many juries out there as to what it is that you are trying to offer investors. obviously you need to have a very, very solid liquidity management function, keeping tab on, cash coming in, cash coming out, whether you have credit lines, etc., to ensure that you can meet redemptions if and when they come. All that being said, investors are coming into the evergreen vehicles with expectations of private equity type returns. They measure it slightly differently, right? Because you're not, it's not the vehicle is not distributing constantly. It is, as you said, reinvesting. So rather than the traditional metrics, you're looking more at a time-weighted return metric. But ultimately, people are looking for, or investors are looking for, capital appreciation, and that's why they're investing into these types of vehicles.
Yeah, so it's definitely not one or the other. Capital appreciation versus liquidity. It's a constant combination of both.
Absolutely.
Yeah. So kind of as we look to summarize the discussion, you mentioned this briefly in the beginning that there's a lot of innovation. Actually, you emphasized it quite a bit that there's a lot of innovation in the market, and rightfully so. Are there any unique structures that you've seen or liquidity solutions that are emerging, in the GP-led space that you were, surprised or excited about it for the next, go forward couple of years?
Yeah. So look, obviously, if you're investing in CVs, it's a longer duration than if you're investing in a very highly diversified portfolio of LP interests. And, what is interesting as well is that we are seeing GPs thinking through what I would call interim liquidity solutions for investors in CVs who may want their liquidity earlier than the natural end of life of the CV, although the CVs are much shorter than, a normal fund. And so what we're seeing, for example, for single companies, GPs organize what I would call sort of midlife recapitalizations, where a minority share of the business is sold to a third party halfway through the journey of the CV. And that's sort of realizing proceeds that dividended out to investors. And, another way of doing that is, if the debt levels of the business have gone down, you can raise, you can relever the business to dividend out to the LPs in the CV. Interestingly, we're starting to see CVs on CVs, and this industry being full of jargons, what I've heard them referred to as CV squared, which are situations where a business was first sold into a continuation vehicle. The business has performed well in the CV. It could be a good time to exit and lock in that good performance, but there is still more room to grow. And so in that case, the GP organizes another continuation vehicle where the company is sold into a second CV. And then here what happens is that the LPs in the first CV are offered the option to sell or to roll their exposure into the overall vehicle. So, overall, a lot of creativity and innovation, not to repeat the word again and again, but, certainly creativity in the market to offer LPs liquidity avenues.
That's interesting. So that could technically continue in perpetuity, right? Of sort of a CV over CV out of CV.
So look, there are businesses like that. And again, I don't want to be drawn in specific examples, but, there are a couple of businesses I can think of that have been in private equity ownership for nearly 2 decades, right? And so they may not have been with the same GP, but they started very small and they were sold from sort of a mid-market or a lower mid-market GP to a larger GP, et cetera, and 20 years later they're still in private ownership. So there are some of these businesses out there that can be held for very long periods of time, and certainly much longer periods of time that a normal commingled fund or even a CV vehicle calls for. And so it really speaks to some of the limitations of your traditional fund structures.
Yeah, and I think with all the volatility in the public markets, there's going to be an even deeper gravitation towards keeping something private for longer if there is a viable avenue for it at the end of the day.
Absolutely.
Yeah. And that actually is a perfect segue to what I was going to ask you about, regulatory changes and
Yeah.
sort of regulatory implications on the industry, because I'm sure that at some point there will be a conversation around, should there be regulation around how many quote unquote extensions you can do on a continuation vehicle, for alignment and et cetera. Perhaps, I'm not sure, but, do you expect any specific changes on the regulatory landscape to have material impacts on the viability or the structure of GP-led deals?
Look, I think GP-leds are becoming increasingly accepted. Yeah, I think LPs and GPs are seeing this more and more as a portfolio management tool for GPs as well, and also a very important part of liquidity for LPs. So I think where there's been regulation measures in the past, they've generally speaking been helpful in managing many of the topics that I mentioned previously. So conflicts of interest, ensuring that, CVs are done properly. And so, trying to help, things be done in a way that should continue to fuel the GP-led side of the market.
And I think the simpler, the more sort of standardized both
Absolutely.
documentation and presentation becomes, right, the more probably helpful it is to the industry in fueling demand and volume.
Absolutely.
Yeah.
Absolutely.
And so with that, if we roll forward, let's say 10 years,
Mhm.
do you see the secondary market in Europe becoming even more GP driven or GP led driven, or will the balance shift towards more, LP portfolio sales, et cetera? Obviously, very probably dependent on the macro environment that we're going to be in, but yeah, what's your take?
Yeah, no, it's hard to have a crystal ball, but I guess what I would say is that the European market, to put it in context, represents slightly less than 30% of the overall secondary market. And if you look at it today, advisors will tell you that it's fairly balanced between GP-leds and LP-leds, maybe not exactly 50-50, but, thereabouts. And as GP-led transactions becomes more commonplace, and we're seeing more sort of mid-market GPs launching GP-led deals. I've read a statistic that 80% of the top 100 GPs in the world have done a continuation solution. And, we're seeing this trickling down to the mid-market. And as that does, we would expect to see more GP-led transactions in the market in general. But now, will that mean that the market will become more GP-led driven? I think it's hard to tell, because as the asset class grows, there's also going to be more stock of LP positions that could be sold into the future. What I think is safe to say, though, is that, GP-leds have become a key part of the secondary market, and I don't see this as going away anytime soon.
Yeah, no, I would definitely agree. And maybe in terms of actually specialization versus consolidation,
Yeah.
are you seeing that trend emerge, particularly in Europe, in any significant way where, is it more, it's becoming more specialized and there's a lot of niche players, or the opposite, where there is a lot of consolidation to broaden the scope of any particular player?
Yeah, no, so we're not seeing consolidation among secondary players. You are seeing the realization from either private equity firms or others of the attraction of having a secondary business. And so there have been either acquisitions or, minority stakes, et cetera, in secondary businesses. But sort of on the ground, if you want, what we are seeing is more specialized players focusing either on one part or the other of the market. So actually, you're seeing either specialized GP-led players or others, even new players, focusing only on the LP-led side of the equation. Look, we at HarbourVest have the benefit of a team that has been investing in the asset class for over 40 years. And, our senior team has been working together for almost 2 decades. I think the statistic is around 17 or 18 years on average. I think what that means is that we have, deep experience in both the GP-leds and the LP-led side of the market. And we've invested in all of these types of deals in multiple market environments. And what this affords us is really the flexibility to invest in the parts of the market where we see the best opportunities at any point in time, which we think at the end of the day is an advantage versus the more sort of specialized players.
Yeah, and it's cool to see though that a lot of the PE shops are buying, if you will,
Yeah.
secondary businesses, because obviously the capitalization is coming into secondaries, both at the GP level, from the LP level, and now from private wealth. So, circling back full circle to your earlier point that we're at the inflection point of another growth spurt in the industry that's going to become even more massive. So it's more and more exciting.
Never a dull moment.
Never a dull moment. Well, Valérie, thank you for sharing your incredibly valuable insights,
Oh,
on
no,
the
thank
GP
you. Thank
led
you.
secondary space. Particularly, I think you saw it from sort of ground zero to where it is today.
Not quite ground zero, but it was certainly niche. And you'd go to cocktail parties and people would be like, "What do you do?" And you would never say, "I work in secondaries," because you'd get blank stares and be like, "Oh, okay." So yeah, now you can actually say secondaries, and people are like, "Oh, right, yeah, people have heard of it."
It's interesting that you mentioned that. I was at Nexus, the PI conference last year, and I said, secondaries, and people are like, "Oh yeah, that's the new, best industry to be in," and that's kind of the reaction that now I see versus, again, call it 10 years ago when I started. It was, "Don't talk to me about secondaries."
Absolutely.
So very different.
I have to say, 20 years later, my parents still don't know what I do for a living. But that's a different story.
And actually, onto that, from a more sort of personal standpoint, before we let you jump onto your day job, I'd love to ask you a few rapid fire questions if you're up for it.
Absolutely. Go ahead, fire away.
Excellent. What is the first thing you do when you get into the office?
Oh, wow. Look, so I guess to put it in context, I have 3 children. And, so when I'm in London, so I'm not traveling or I don't have an early morning meeting, et cetera, morning breakfast, I guess, I try to take them to school, although they're old enough now to go by themselves, but, just to spend a little bit more time with them, which means that by the time I get to the office, I've just had a morning of chaos. And so really the first thing I do, I stopped drinking coffee a few years ago. And the first thing I do is actually sit down and have a cup of tea. I have kukichas tea, which is a Japanese twig tea, caffeine-free. It's calming. It sort of, helps me set my day. And with that cup of tea, I sort of go through the news of overnight that I haven't gone through in the morning, and really sort of strategize for what tends to be very, very busy days in the office. So that's my first thing in the morning in a nutshell.
That's incredible. That's my goal, because I unfortunately result to opening up my inbox, and that just goes down a rabbit hole.
Yeah.
And it's never ending.
Yeah. No, sadly, I do that even before I wake up the kids. But at least I can afford that moment of calm when I get into the office.
That's incredible. What is the single biggest factor that contributed to your success with HarbourVest, would you say?
Yeah, and look, it's going to sound cliche, right? But I've been very fortunate to have some very good mentors in my career, and that has been incredibly valuable. Really, I think, especially mid-career, which as a woman tends to happen when you're having children or you're getting married, and there are important things in your life happening, and you're juggling a career. It's very easy to have tunnel vision and not really see the big picture and just go, and you're probably the biggest thing you worry about is how much sleep you're going to get that evening. And so having someone who forces you to even take an hour every couple of months to step back and think about your career, where you're going, why you're going there, has been extremely valuable. And if you have a good mentor who has a vested interest, is genuinely interested, I think that goes a long way. And it's why now that I'm a bit more senior, I mentor women at our firm to try to give back what I've been given. And I think it's extremely important. And it's actually, sitting on the mentor side of the equation, I find extremely rewarding because there are some amazing women out there that I get to interact with.
Well, perhaps we'll see one of your mentees on the next podcast in a few years.
I certainly hope so.
And it's so good that you reward, because I think it is a big reward for somebody as well when they can join hands with a mentor and feel like what they're doing is also valued and seen, right?
Absolutely.
From a mentor perspective.
Absolutely.
That's great. What would you do if you were not in finance?
I'd be an architect. I was very close. I was very close. I think architecture is an amazing industry, and just building homes for people, creating the cities of the future, transforming the landscape. I think, it's exciting. And if in my next life, I think finance has been exhilarating. It's been great. I wouldn't change it. But if I had a second life, I'd love to try to be an architect.
Well, you could say your skill set is definitely probably being used in sort of building the industry in finance, if you will make that parallel.
I guess that could be an analogy.
There you go.
Creative, but less artistic.
Less artistic. I agree. I come from a ballroom dance world. I used to be sort of a Canadian finalist for ballroom dance.
That's amazing.
And yeah, you definitely see how that hobby, or like a creative hobby, can help you be more versatile and sort of more open-minded in a structured career, right? That's a little bit less creative in that sense.
Yeah, no, but that's been amazing.
Yeah, it was a great part of my life. I'm very grateful. It made me very competitive.
Yeah, inevitably.
Yeah. What is your best place for a vacation? Your ideal spot?
Yeah, no, so look, so traveling for pleasure is one of my passions. And so for me, and look, I've been very fortunate to travel a lot, especially in my youth and when I was at business school, after business school, before, etc. So for me, the ideal place for a vacation is somewhere, especially that now I travel with my family, and I have 3 teenage kids. It's really a place that combines, a sense of adventure, a sense of discovery, somewhere where you can have fun, see new sights, but really get pushed a little bit out of your comfort zone. And all that always needs to have a bit of relaxation in it. So, at least a pool somewhere or a beach somewhere, so yeah, that's sort of the type of things I look for in a vacation. And as a result, our next holiday will be in Jordan.
Ooh,
I'm taking the kids to Jordan.
Fantastic.
Some people think I'm mad, but I no, because the region is not the most stable, but I think it'll be fine, and I'm very, very much looking forward to it.
And I think your kids, when they grow up, are definitely going to value that time that they got to see the world as well and sort of experience new facets of life.
I think that's very important. It is really important for kids to come out of their day-to-day and see the world.
Yeah, 100%. Well, thank you so much, Valérie, for really speaking with me today. I feel like I had a full 20-year GP-led primer consolidated into sort of our chat. So there's a lot to unpack there, and I hope, I know it's going to be valuable for people that are watching this to just...
I hope so.
Sure.
And thank you again for inviting me. It was a pleasure.
Thank you so much. And once again, everyone, this has been Valérie Handal, MD at HarbourVest Partners in London. And thank you, Valérie.
Great. Thanks so much.
And if you guys have enjoyed our episode so far, love to hear from you. If there's other guests or women that you'd like to see on the show or topics that you'd like me to cover, please feel free to send me a PM on LinkedIn. And as always, watch our Secondary Link LinkedIn page for updates on our next special guest, and hope to see you in a few weeks where we highlight the next incredible women on the Women of Secondaries.